everybody. Welcome to the Monthly Market Insight. This is the first Monday in March. It's March 7th. And so first off, I want to start and say, our hearts and our prayers are with everyone in Ukraine and everyone that is affected by this crisis. And so with that being said, we know that's what's going on in the world. We know that's in the conversations we're having and the questions we're receiving. Is how, this crisis, this geopolitical crisis, putting that into perspective. How does that affect you? It is a very evil and serious thing going on in the world. So we don't want to make light of that, but we're going to put it in the perspective of an investor because those are the conversations we're having and the questions we're receiving. So Sean, if you want to kind of walk through, put some things into perspective, answer some of maybe the questions that we've been having in the conversations this past month.
Yeah, so I think it's always good, right? And everything that we try to do from an investment standpoint is always evidence-based. So are you seeing my PDF screen here? So, we want to go back and look at history, look at data, find out how the markets reacted when we went through similar situations. And so we found this report. We want to kind of go over this. So we're going to put some of those geopolitical tensions in perspective. Okay. Awesome. So here's kind of some geopolitical history and how the market reacted during those times. So we have the Cuban Missile Crisis in the early 60s. And we could see that when we do have some type of international conflict, the markets may or may not react. And so here's a couple of data points. Cuban Missile Crisis in the early 60s, the S&P lost about 13%. The Gulf of Tonkin incident, which really drove us into the Vietnam War. Again, kind of the mid 60s, the S&P stayed relatively flat during that time period, but we did see an initial pull down. Then the Iranian hostage crisis in the 70s and 80s. We can kind of see that the market ended up doing very well after kind of some near-term kind of drop or correction, if you will. We look at the Iraq War in the early 2000s, last a little bit longer, almost a little bit over a year until the market started to come back. But we saw the market lose about 15%. And then most recently, and maybe something that's most similar to what's happening right now, was the annexation of Crimea in 2014. And so that's a very similar situation to what's going on right now. What happened then was Crimea was a part of Ukraine. Russia went in and essentially took it over. Annex means, I had to Google this, right, because I didn't know, but essentially means a military force goes in and takes over another country, kind of seen as illegal to do so, and puts in their own government. It's still recognized internationally as being a part of Ukraine, yet Russia has decided that it is going to be a part of Russia. And so they created its own Republic of Crimea. That happened in 2014. Russia is trying to take over control of Ukraine to kind of reestablish the former USSR. And so that's a lot of what we're seeing. When we're talking with clients, we're asking them, are you spending less money? Are you not going to work? Are you changing any of your habit patterns because what's happening in Ukraine? And everyone's answer is, well, no, right? No, I'm still going to work, still going out to eat at restaurants, still buying things. And so I want to put that in perspective because we've been through conflicts in the past and the market has seen these, kind of corrections. They've seen them all as temporary impacts in the market. And I think what's probably more relevant to what's happening is the news cycle, right? It is 2022 and we have a 24/7 news cycle that wants to scare us, right? COVID is over. The media is not really talking about it. And now they're looking for something else. Here's a great situation for them to ramp up their ratings again. So we get influx with all of this scariness, all of these bad things, and it creates more fear in us. We see the market pull back. So I want you to realize that it's all temporary and to be able to block out some of the noise. And the reason is because what's actually happening in the market is we have a really strong fundamental market. Okay, so we look at consumer prices. If you don't know, your home's gone up in value like crazy here recently. We see consumers' net worth going up drastically. And again, a lot of these are tied to kind of our real estate. people's largest equity position a lot of times is their real estate. So when their home goes up in value, their net worth goes up in value. So some of the reports that are coming out are showing that people have higher fixed debt, if you will, right, kind of tied to low interest mortgages and real estate. And they have much lower balances for revolving credit. So credit card balances are down. People delayed paying their student loans. They put that money towards your credit cards. They took some of the government stimulus and they paid down their credit cards. All of that higher net worth, lower revolving debt lead to the ability for the consumer to spend. 2/3 of the US economy is built on consumer spending. So we're seeing a lot of people with capacity to spend. We just had a February jobs report come out. They were expecting to add 400,000 jobs, and we added 678,000 jobs, right? Almost doubled what the expectation was. So we see labor force participation rate, right? There's kind of the coronavirus drop. We're starting to see that return to normal. So as we see some of the service industries picking up, we start to see that unemployment number going down. So we have really low unemployment. We have people with higher net worths and more capacity to spend. We have a stronger economy underneath all of the noise that's happening right now. So that is one of the reasons that we believe it is just a temporary market that we're kind of going through, a correction, if you will. What that doesn't tell you is when does that end? Okay, so I don't know if the 10% drop that we're seeing so far in the S&P, around 14% in the NASDAQ so far. Not sure if we've hit the bottom or if we have another 10% to go or so. More recently, we look at the end of 2018 and we see the Trump and China trade war kick off at the same time that the Fed tried to raise the interest rate. So again, a very similar situation to what we're going through right now. High geopolitical tensions, Fed trying to raise the interest rate, which is coming here next week. And we start to see that the market pulled back to about an 18% drop in one quarter. So does that mean we have another 8% or so to go? I don't know. Now, we don't try to get into that, gambling and forecasting and all of that, because it's a zero-sum game. It's a loser's game. But we do say that, hey, long-term, the market's going to be really positive, and the market's discounted right now. Just don't know if it's fully discounted. So reservations, restaurant reservations, again, kind of 2020 through the coronavirus recession, all coming back almost to normal. So restaurants are at more capacity. People are out there spending money. All of that, again, leads to a healthy market. Companies make money when people spend money. And when people have the capacity to spend, then they will spend. So we see S&P 500 earnings per share, right, going up extremely high. Okay, again, what that shows us is that markets are doing well, companies are doing well. When we talk to our small business clients, all of them are talking about how they had record years last year. Things haven't slowed down for them this year, which again is why we have a great jobs report. Companies are doing well on their balance sheets. The 10-year treasury, what we tend to see with this is as the markets decline, that's because as the 10-year treasury declines, the market's declining because people are looking for a more safe asset. They're getting out of equities, going to something safe like government treasuries. As we see the 10-year treasury rise, it shows an appetite for people to take on more risk in equities. So we're seeing the market kind of point to signs of growth in really all phases other than the news cycle. Okay, and that is just going to show us that we have some temporary downturns in the market right now. So if we go back and look at some of those things that we talked about initially, in the 60s, we saw some of those incidences. The S&P 500 has obviously done really well since then. That doesn't mean it will continue to do well in the future, right? Past performance is not indicative of future results, but the signs are really, really healthy. There's a lot of data support that we're just going through a temporary blip and that we're going to have a really strong outlook long term. So near term, right? A lot of uncertainty. Long term, we feel like the fundamentals of the economy are still extremely strong. Okay. So that's a lot of kind of the geopolitical tensions. I want to put it in perspective. We've been through this before. We've seen the markets react temporarily down, but then move to a positive. And right now, we're kind of in a very similar situation. Things that we are more interested in, things that will affect the US market more. We're really excited, right? As the nerds that we are, of listening to that inflation number, right? The CPI is going to come out for February on March 10th. So this week, we expect that number to be higher. If you'll remember, it was 6.8% over the last 12 months in December, 7% in January, 7.5% in February. What we want to see is, does it stay at 7.5? Does it go down or does it go up? Kind of some of the preliminary reports said it's going a little bit higher, which is why we see things like real estate do really well, commodities, oil, all of those things are moving farther positive, right? Having good gains. And that's because they're a great inflationary hedge. It's going to cost more money to fill up your gas tank. As inflation rises, those companies tend to profit off that. So we're seeing things still moving the positive. Really interested in seeing what this Thursday's number comes out for a consumer price index. Also next week, the Fed meets March 15th and 16th. And so on the 16th, they're going to have a press conference, and that's going to give us an indicator of how much they're going to raise the interest rate. What we believe, what we've seen kind of through these first couple months of the market, is the market trying to price in how drastic is the Fed going to raise the interest rate. We all know they need to, because right now we've got a lot of inflation, which again is a sign of a healthy economy, because people are spending money. There's just not enough supply there for people to keep up. And if you try to buy furniture, right, it took us 9 months to get a couch. That's a great sign that we were still willing to spend money, but there just wasn't a supply there. So the prices go up. So what the Fed will do is they'll raise interest rates to stop people from spending money. You may not want to go buy that couch. You may not want to go take on a mortgage if you're going to have to pay more for it because interest rates are higher. So that's the macroeconomic concept. Raise interest rates, people will stop spending, slow down the economy, let the supply catch up. Again, they'll feel confident to do that because we have a really strong, low unemployment, strong economy, a lot of consumer spending capacity to follow. So we want to see how much they raise it. Everyone's kind of thinking it's going to be 0.25%. Do they go higher than that? Do they announce that they're going to do more than just 4 rate hikes this year? All of that is still unknown, and the market's trying to price that in. So I think those are some really good indicators of what we're looking for here over the next 2 weeks, and kind of blocking out the news cycle. Don't worry too much about the geopolitical tensions in terms of your portfolio. Focus on the strong fundamentals of the economy.
All right, thanks, Sean. So if you have questions, whether that's on the crisis, how that impacts you, CPI numbers that are coming out Thursday, or the Fed meeting next week, please reach out to us. Just know it's an extremely fluid situation. There is going to be short-term volatility, but don't let all the fear make the decision short-term for you versus the long-term. Sean and I are here for questions. We're happy to educate you and provide more data based on evidence for you. If you have questions, please reach out to us. If not, we will catch you back in about a month in April.